My name is Max Gagliardi, and I'm here with co-host David Heikkinen for this week's Talk.Energy Insights. And we've got guest Ross Hendricks with us of the Ross Report, as well as energy funders. Ross, thanks for coming on.
Yeah, thanks for having me. This is great.
Yeah, good morning and happy early New Year to everybody. What a year we had. Finally had energy actually as the top performing sector, and a lot of good stuff we can talk about on the macro going into, really what I've coined is, a global energy crisis from underinvestment. But actually, you can see it on the European gas side. You're going to see it as crude oil prices are rallying. I still think oil goes above 100 in 2022. I just think there's this real market sentiment shift from the 2010s where we probably destroyed $300 billion of capital with U.S. shale investments, but really that gave this economic boost to the global economy of low energy prices that now has the world still addicted to fossil fuels, but also in the situation of dramatic underinvestment. And Ross, I know you've written a lot about this, and I know we'll get into the macro. We can hit NGLs as well, kind of the progression of exports. I think a lot of people don't pay enough attention, and it's something I know we at Heikkinen Energy early in the year, and then with the merger with Pickering Energy Partners at mid-year, we've talked a lot about. So I look forward to the conversation. I don't know if everybody knows Ross. Maybe Ross, you can start out with just an introduction, of just give your background, and then we can kind of kick into things.
Sure. Yeah. I kind of have a weird route that I got into where I'm at. I started off in the energy industry coming out of college, working in like the service sector, and then I took a kind of a 4 or 5 year hiatus to go towards like the financial side of things. So I went and worked for a hedge fund in Phoenix for 3 years and did global macro investing. Then went to a research shop that just focused on subscription research, and then finally found my way back to energy funders, and then now more recently starting a research service on Substack. But yeah, it's amazing that I think your synopsis, I 100% agree. We've come so far from everyone in the March, April 2020 depths of the crisis. It was like, oh, this is the death of oil. This is the final sort of death rattle of this industry. It's just, we're all going bankrupt. And then you fast forward 18 months later, and it's like full-blown energy crisis. So it's an amazing turn of events we've had. And I think I agree with your high-level macro that the world is going to basically find out just how critical not only energy is, but energy investing in the next few years, because I totally agree. I think we're setting the stage for a crisis. I think European nat gas is kind of the just a preview of what's to come. And if that happens on the global oil market, I think that's a real crisis that it's not just Europe. I think we're all going to be dealing with it in the next few years if we don't change sort of this investment capital starvation trend that seems to be ongoing.
No, I think you're spot on, and probably helpful just for everybody. As we've defined an energy crisis or any commodity crisis, there's kind of 4 characteristics that we've talked about on the pod in the past, Max. But first, you have a pre-crisis erosion of spare capacity. And then second, you have a failure to appreciate the increasing risk and then a failure to take preventative action. Third, you have a short-term trigger that, really is that snap that triggers a potential shortage into an actual shortage. And that's what European gas is going through now. And then on the other side, every commodity cycle will overreact. But I think this one has some duration. Where we'll overreact to the other side at some point in time. My concern is that there are 2 ways that the Euro gas market can see things. One is, gas, they need more supply and figure out a more reliable source. But the reality is gas traders just, really became, really complacent in their securing gas. They broke the crude oil contracts when they thought LNG would be readily available. And all while that's going on, you had North Sea gas production decline by 40% because of underinvestment. And so this really interesting time, and I'm looking forward to getting into things. So Ross, when you think about a crisis, like where do you think, like how did things start? I'm just curious as you go back through your career, your progression, and what would be your starting point?
Yeah, it's interesting because I think the starting point is we can actually go back to 2014 when I first came into the industry. I guess I came in probably more 2012, 2013, but I got onto the investment side of things in 2014, and that was right at the peak of where people basically realized that, the U.S. shale industry, not only did they overpromise in terms of, I guess, cash flows and what the reserves would end up being and the ultimate full cycle cost of all this production they were bringing online. I think we can trace today's crisis back to the shale boom, where investors, they saw this big growth industry and they poured tons of capital into it thinking this is the next great thing. And then they realized, well, the returns are actually not here. It's just the shale business model is fundamentally just unsustainable, or it was from the 2010 to 2016 era. And so I think that disillusionment, and then compounded by ESG. So I think, I forget who it is on Twitter that's always hammering me about we can't fully blame ESG. We can also blame the industry for torching capital. And I do think it's those two components. So investors have had not just the environmental reasons to stay away from the space, but they've just been burned so badly over the last decade. And I think that's what's setting the stage for this capital retreat, is these two powerful factors. And they seem to be with us. No one seems to be, I guess we are seeing an uptick in the rig counts, and we're seeing production U.S. I think the latest, I saw a projection yesterday from, I forget who put it out, but I think the U.S. is supposed to add close to 1 million barrels a day next year. So it's not as though we're totally not going to spend any money on the space, but I do think that the last decade, you have a bunch of capital destruction, and then now ESG. That's really what's setting the stage for this underinvestment. And I think, as we all know, the biggest thing you need to get oil is a lot of investment. And it's a treadmill. And if you're not putting a ton of money into the space over time, you're going to undershoot and then if you compound that with, I think the demand story too is underappreciated. Like, we're heading towards new highs in demand. And that's the other angle. The ESG narrative has caused everyone to think, oh, we're just going to, move away from crude oil. But I think we're going to be surprised by how resilient the demand is.
No, I think I'll take the under on 1 million barrels a day of U.S. oil adds. We basically modeled 70% of oil, and then met with the 5 largest, Permian privates, and modeled them as well. And we're not close to 1 million barrels a day. And so I actually think we have this squishy first quarter of inventories, but you're already starting to see with this week's inventories kind of a positive indication. But once we get past first quarter, and any worries on Omicron, slowing down any travel, which I think it's actually just, we're at record levels of cases. My wife's a doctor, and, Memorial Hermann is sending out notes to doctors every day to try to discharge patients because they're filling up. But the reality is it's not, the treatments are so much better now, and, vaccines are working. We had a very COVID-y Christmas with 2 breakthrough cases in our house, but both were asymptomatic, essentially. A little bit of a sniffle. So yeah, luckily, we stayed away from the grandparents because of it. So grandma was bad, but we'll see each other on her birthday next week, so that'll be good. But yeah, it's an interesting time.
The only thing I was going to add on that is this concept that all barrels are created equal, and you look at the total supply, and when you think about the U.S., it's all those things you mentioned, Ross, and then it's this precipitous drop because you had all this new production that's come on in these shale wells, and so it's like the drop off is hard and quick, and then the climb back is arduous and takes a ton of capital. And to David's point, I think the under is, I'd be leaning that way too, on getting back out of that hole. It's not just as simple as there was this many barrels, now there's going to be this many more.
Well, you had I think you're going to see consolidation as well in 2022. It reminds me a little bit of the early 2000s. I'm older than both of y'all, but I just have this feeling of consolidation has led to companies putting a cap on volumes. You think about Conoco, Concho, and Shell combining. You think about Pioneer, Parsley, Double Point. Essentially those companies, Devon, WPX, are all 5% caps on really volumes or less. And so, that's that consolidation that will continue. A couple privates that are out there that are kind of running the dual path of come public or most likely try to get acquired. But, when those acquisitions happen, those companies won't grow as much. But, I think
that's the interesting thing that I'm trying to wrap my head around. Is I think we all agree that there has been capital impairment, and I think we're all probably pretty bullish on the demand side of things. The Omicron could end up being a blessing in disguise for reasons people have talked about, but if it's, the lesser potent strain takes over, this thing could blow over before we know it, the whole COVID, like lockdowns and all that stuff. So yeah, the production side, I think, is the biggest unknown. I think it's fascinating that you have a different view based on kind of boots on the ground research or kind of a bottoms up model talking to the players. I think that's the best way to get your head around production. And I haven't done the work in terms of looking at the individual companies in the space. I kind of just look at it from a macro perspective because I'm not out there trading crude oil. I just kind of look at it from a perspective of like the companies that I invest in are like right now a lot of pipelines and refineries. I just want there to be like a moderately bullish view. But I think so when I looked at natural gas this winter, that's the one where I feel comfortable trading it because you can kind of get your head around what you think supply and demand is. You don't have to deal with the global economy. It's very much a domestic market. I think it's one of those ones I feel comfortable trying to kind of play my hands at figuring out where gas is going to go. And the thing that, I think the market and the U.S. traders got wrong this summer and early fall, which provided an opportunity, was that no one expected U.S. gas production. I think people were viewing U.S. gas producers in the same light as oil, where oil, I think there is a very different, there's a stronger capital impairment in the oil sector, but nat gas, I've just been burned on this space because I used to be super bullish on that gas. I thought the LNG story was like a secular reason to bet on higher prices. But after really digging into the space, I realized that these producers, anything above 3, they're going to hammer, put their pedal to the metal in terms of ramping up production. And that's what we're seeing. The EIA's latest data showed in, I think it was October data, we're at the second highest nat gas production on record. And producers did respond to higher prices, and that killed the bull thesis, along with the warm winter weather, which also, no one can predict that, but that was a nice tailwind to the short side. So I guess the thing I'm trying to get my head around most for oil is really figuring out the production side of what the response is going to be. And will these guys all stay disciplined if oil goes to 100 next year? That'd be a dream scenario for the E&P space, but so I'm just curious what your thoughts are on that.
Yeah, so I can boil it down to, let's just talk individual companies. It might be helpful, just perspective of, so first on the private side, so you look at a company like Mewburn running 20 rigs, I think all but 2 or 3 of those are in the Permian. They went from 10 to 20 through last year, but now they're at kind of a peak sustaining level. Endeavor kind of at the same, 5 rigs less than that. Crown Quest is out there. They're likely, potentially going to monetize. Then you have a handful of smaller companies, kind of a smash go, set of companies that are there that really ramped volumes to try to ramp EBITDA to try to get a higher valuation. The reality is they're not going to see a multiple expansion, and so the way to get a higher value is to have more EBITDA or more cash flows, and so that's why they ramp. The issue is on the other side when you scramble eggs, 1 plus 1 probably equals about 1 and 1.8 on the combined outlook into 2022, and so that's the private side of what you ought to watch. Then you think about the public side, it really is Exxon, Chevron, and BP from ramping of activity, and we had BP at our conference in Austin. That Max, thanks for attending. Really, they're in a situation of going from $1 billion of lower 48 capital to $1.5 billion in 2022 to be $2 billion after that. But really, their goal, overall, is to shrink their total global volumes by 40%. The U.S. will grow some in a combination of oil and gas, and then then you're left with, like I said, Conoco, Pioneer, and Devon that are all living in a return of cash model, and so the variables that are left are, EOG, which is meaningful. And then Continental, just entering the Permian, really doesn't have any big ramp of activity on the old Jagged Peak, Parsley, Pioneer assets. They're still trying to figure that out, and it's a little more geologically complex. And so what's interesting about the global oil market, it reminds me, you said you kind of got into business in 2014. Max and I have talked that we founded businesses right before that crash. And what was the benefit is you could understand, at that point it was about 45 U.S. producers that we had to model to get an idea on global oil supply growth. Now I just listed about 10 companies, 3 majors, about 4 large privates, and then really the 3 public companies that are returning cash, Conoco, Devon, and Pioneer, and then you have the wild cards of Continental and EOG. And so it's not that many companies that are going to drive that much higher volume growth. And then I do think that there is this discipline, and so it takes about 2 years in the mining sector and in the refining space. You said you've looked at that a little bit. You got into a counter-cyclical return of cash and a lack of growth capital. And I think that's happening now in the U.S. independents. And I think they're going to return a lot of cash, through 2022. And so and then I do think consolidation happens as well. And so the use of their equity or use of some cash will be to buy some of these privates that I think are going to try to sell versus come public. So I just think there's these caps on 2022 volumes that, this 800,000 barrel a day comment that I've seen people say about U.S. oil growth. I just don't know who's going to deliver it. I don't, and I can list through all those companies, got spreadsheets built on all of them. I actually have area models built on all of them, including the privates now. And one of the blessings of Pickering Energy Partners is we've got a large private equity investment group and a large public equity investment group, and we put our minds together and just think about where this network of, okay, I need to get to know the guys or gals at these private companies, and kind of 1 or 2 degrees of separation, we can do that. And now the benefit of the public side, what we do in Insights is, whenever one of these companies buys one of these other ones, we have an easy way to plug in and say, is this good or bad for Conoco when they bought the Shell assets? Because we built that model in June of 2021, whenever it was very clear that Shell was going to be selling well before the deal happened. So I'm not trying to, that wasn't a plug for our business, but it's just saying we have a better view, kind of the same feeling of what we needed to know in 2014 of the U.S. oil volumes are going to grow a ton more than people expected. Now the U.S. oil volumes are going to grow a lot less, other than gas. Like, this is the one thing that I think people are missing. Natural gas out of the Permian, I actually think there's going to be, very low Waha prices again, much sooner than people expect. Because there is still a lot of associated gas volumes, but there's also a lot less flaring and a lot more capture going on. In fact, we're actually thinking that the Delaware is something you need to be a little bit wary of, and I've talked a lot about it. But I think the gas side in the Permian is something I think is going to grow more than people are expecting. So, I know you wanted to hit gas. I know you wanted to hit gas. You're a little bearish on gas. We're a little bearish on gas. At least on basis. I don't know if global gas at all. I'm pretty bullish on that. But you said you were bearish gas as well, Max, and I know you're kind of tied into the private companies in Oklahoma, and we can go a lot of different directions around gas and NGLs next if y'all want.
Yeah, just going to say real quick on the gas comment back on that. I mean, the only thing I see is that looking at privates and talking to groups, and for example, like in the Haynesville, we don't do a ton in the Northeast. But whether it be the Haynesville, even in the Permian, right? Like there's issues around treating capacity. I mean, there's these little choke points along the way that on the gas side, I think, you talk to somebody in the Haynesville and they say, oh, we're going to get after it. We're going to put 2-3 rigs, in this area. Or you see somebody that's doing a big acquisition in the Haynesville, can't go into specifics of different companies, but you start to put, it under the microscope and you don't have compression capacity. The pipeline needs to be, there's pipelines that need to be looped at the gathering level. You can't just bring on, in some of these areas, it's hard to bring on hundreds of millions or, BCFs of gas without longer lead time. So there'll be something there. I think in the Northeast, certainly it's getting harder and harder to build pipelines. That's bearish. I think you've got areas like from the associated gas standpoint. I mean, we were seeing BCFs a day coming out of areas like the Mid-Continent or coming down from the Rockies. I mean, significant gas flows that have not only almost completely gone away. I mean, I think in the Mid-Con, it's like, I don't know how much we've lost. We've lost a lot. I mean, multiple BCF. It's continuing to trend down. I mean, there's no upward growth in that. So I think that these guys have the ability, sure, in the core areas to increase gas volumes very quickly. Will they, because of capital and because of infrastructure, I don't know. I think it may be. I think the floor is going to be higher. I guess this moving forward.
I think that NYMEX can be higher and basis is going to be worse. If I wanted this group to have a takeaway, and there aren't. I mean, Kinder Morgan. We did a report, Michael Cusimano, on time to build gas pipelines out of the Permian, and I think Kinder's the only company that is considering another export solution, and it's maybe late 2023 at this point if they started an open season now. And I just think there's this bottleneck that's going to exist around Waha, which is going to drive very low Permian gas prices, which actually there's some interesting stuff going on around cleaner gasoline, and I think they can talk some about that, but like there is definitely a degree of like alternate uses for natural gas, and trying to think through how to tap into this. Carbon hydrogen bond is an immense store of energy, and it's the oldest solar energy in the world. I joke sometimes when I talk about the solar space, which I've had to do a lot more in the last 2 years. But like I do think there is like a lot of opportunity, and really you just go up the chain a little bit. NGLs I think are going to be the biggest flow through. We've had a lack of winter really in the U.S. and propane prices have come down, but the Euro demand and the NGL exports, Ross, is something I thought we could let you talk some about, because I do think there are opportunities and investment opportunities to really capitalize on that.
Yeah, absolutely. And I was going to say, I think gas, dry gas, and NGL kind of tie together. My bearish view on gas was more of a seasonal thing. I do think long term there's this great arbitrage between low cost shale, where these guys can really make some good money, even at $3.50. And then just, factoring the export cost and the shipping costs going over to Europe and Asia, where there's really no solution for them other than Russia, which is a whole geopolitical thing. But I think that arbitrage is going to be wide for probably years to come. And I think that does set up some great opportunities, whether you're looking at either the dry gas E&Ps or NGLs, like you mentioned. I think it's an even more bullish story, because there's a couple of factors. I think that you have really strong demand in Asia for U.S. NGLs. And I think that you also have a big growth demand in the domestic petrochemical sector too. So it's not all just exports. Whereas with dry gas, we are going to have probably more power plant demand, but it's mostly an export story. And you have these multi-year lead times to get an LNG terminal built up. And so I think if we look out to like the mid 2022s, we're starting to see a lot new volume of long-term. I think just last week or recently, there was a big deal between China and Venture Global signing these. I think we're going to see more and more of these long-term LNG deals. That's going to set a really bullish picture for U.S. dry gas. But in the short term, the NGL story is extremely powerful, I think. And it seems like there's it's hard to get a pure play, but the one company I like most for that is just Enterprise Product Partners. They're basically set up to be a leading exporter and to capture that trend. I think they get around 50% of their revenues from NGLs. And the thing I like about a company like Enterprise is you don't have to make the call on what global oil prices are going to do the next year, or gas prices or anything. It's kind of just a volume story. As long as there's going to be an arbitrage between U.S. gas and NGLs versus global prices, they're going to be there capturing that arbitrage through their export network and just really stable business model, 9% yield. So I'm kind of looking for opportunities like that where I don't have to get too smart about, the global outlook for. Because if we kind of go back to the oil story, the one question I wanted to follow up with you on in terms of the supply side is the big unknown is what's OPEC going to do, right? And I do think that a lot of the capital impairment that we're seeing that you mentioned among the major U.S. and European players, that's kind of one of the under talked about points, I think, with OPEC spare capacity is a lot of that capacity over time is developed by Western capital coming in, whether it's joint ventures or just outright owning the assets. And so I think that, and I'm curious to hear your thoughts on where do you see OPEC supply going? And there's this kind of narrative out there that the spare capacity is much lower than what the market generally expects. And so I think that plays into the capital impairment. If the Western capital is not there to develop these assets, maybe OPEC spare capacity, maybe there is some truth to that belief that the capacity just won't be there if we go towards even greater highs in demand 2023, 24, and so on.
Yeah, and so the question for OPEC is, it's actually interesting. I hadn't thought about it this way, but it's really a small number of countries and places to watch for spare capacity there. UAE, Saudi, and Russia, essentially. Yeah, and a little bit of Iraq, and then Iran as a wild card. The question is going to be how their underinvestment actually, they can respond, and how much black market oil is actually being traded. But so it's again just really there's three countries in OPEC plus to think about: UAE, Saudi, and Russia. So that's where we kind of focused our time. But the question really though is do you need a market share battle again whenever the U.S. isn't really trying to grow? And so essentially I think there's this call on demand that is going to lift, kind of raising tide lifts everybody's budgets and benefits. And I keep saying this, north of $100 2022 is my own opinion. It isn't in the Pickering Energy Partners vernacular yet, but I think it probably will be. I've been in the north of $80 since Max and I started recording the 23 or 24 of these we did starting in May, and that's kind of proven true as well. And so, the call on the U.S. is probably going to be higher than what the U.S. can deliver, and then that absorbs OPEC spare capacity through the first quarter and into the second quarter, because really the world is addicted to cheap Chinese goods, and I think there is this reality of where demand is going to come from is still spurred by consumerism. So
I think that's a great point you bring up about it's not just what the spare capacity potential is, it's the whole game dynamics of the global market have shifted, because you're right, like if we go back to 2014, 2016, OPEC was engaged in this struggle with shale, and they had a reason to flood the market and kind of try to punish the sector. But now that ESG and capital impairment is here, it's a whole different ballgame where OPEC can take their time and be disciplined, and it's in everyone's interest. As long as they don't have this threat from shale, it's in the broader OPEC's interest to just, keep the market tight. And that's historically, they've been pretty good at managing the market. It was shale that kind of ruined their party. Yeah. So I think that's kind of an unintended benefit to the global oil market in terms of higher prices is OPEC is not as much pressured. So even if they have spare capacity, maybe they don't care to utilize it to keep prices comfortable for Biden's political talking points or whatever. I think that the idea that the U.S. can exert pressure on OPEC, I think that narrative is also changing too. They seem to be going their own way and not being so influenced by U.S. Presidential or whatever. You could argue that historically, I don't like to get too much into politics, but you could argue that the U.S. administration could try to force, if we got into the true energy crisis scenario where we're at 100 plus barrels, there could be a political component where OPEC decides to flood the markets just for fear of upsetting their allies. But that's an open question as far as I'm concerned. But I do think that the impairment of shale gives OPEC more breathing room to at least get prices comfortably higher. Maybe $100 is the new normal in that environment, or something along those lines.
Yeah, I think the reality is for energy stocks, you don't need anywhere near that to actually justify buying them today.
Exactly.
Even though, like I started this out, not everybody was on, but we kind of recapped the year. I mean, best performing sector in the market, and still, very much deeply in the value side, and values underperform momentum, for the entire time of stimulus post 2008. So it's really a bet on macro. I don't know if you think stimulus is going to keep going, but we don't have to go down that path. But I do think there is this question of valuation, and future cash flows matter. And as you get into returning 40 to 50% of whether or not that's cash flow or free cash flow through buybacks, dividends, and variables, that money is going to flow into people's budgets at some point, and they'll be like, maybe I ought to own some of these independent E&Ps, or maybe I ought to own some of these midstream companies. That I think you hit one thing to look at on Enterprise that we thought was interesting is you get the benefit with their offshore oil terminal off coast of Texas that they're proposing. You not only get the benefit of more oil exports, but it frees up their existing terminal capacity for more LNG exports. And so essentially it's a double benefit you can use the existing terminal in the future, and they're just thinking about, again, like how does the U.S. Take the value that we have and feed global demand. And I think NGLs are definitely a component of that, and Enterprise is definitely thinking longer term around those perspectives.
Yeah, I think that's exactly right. That's the nice thing. Like I said at the beginning, I hate trying to forecast global oil prices because it's just such a hard game. But we're in this nice environment where you don't have to be a genius and predict, global demand and supply and all that. Even at current prices, there's so many great opportunities, whether it's companies in the midstream space like Enterprise. I mean, I find it incredible that you have a company with a 9% yield that has the track record and the management team that they do in the asset base, where it's, through boom and bust, they just churn out cash flows because they really don't care as long as the volumes don't drop to zero, right?
Yep.
And then you have like the refiner sector, I think is interesting. And then even E&Ps, I think some of the U.S. E&Ps are interesting, but I also really like the Canadian sector. So there's companies like Suncor, you've got almost a 6% yield, I think mid 5%. So there's just incredible opportunities, and you don't have to even have higher prices. Even today, you're getting these great cash flow yields with returning the capital through dividends and share buybacks. So it's kind of a no-brainer.
And hedges are rolling off, and so you get the hedges of 2020 that kept a cap on the billions and billions of dollars of money I guess the banks made on the other side, but they monetized those. But the reality is, in the next 2 years, hedges are rolling off as well. I'm curious, as you think about the Canadians and really the upstream companies, have you thought at all about where carbon pricing should go and kind of where how that actually impacts values and thoughts? We just hadn't talked beforehand. I don't know if you have no thoughts on carbon, then that's we can end the conversation there. But I didn't know if you had any thoughts on it.
Are you talking about sort of the carbon offsets?
Yeah, exactly. Yeah.
That's one thing that worries me about the Canadian, the regulatory environment. It just seems it's a little harsher up north, even though I think the oil sands and some of the assets are better than shale. You do have that. So that concerns me. And then the other thing is, you have companies like Suncor that are being sort of pressured to go and pursue these renewable assets or renewable projects that are clearly lower IRRs. And, there's a reason that, people are not spending money on a lot of these side projects, but they're doing it for PR purposes or whatever. So that's the other thing that worries me is regulation, and then just the shareholder base ESG component. I don't think ESG is going to have any impact on the global demand side, so prices are going to be higher, but I do think that they can force these companies to make bad capital allocation decisions. So I don't have any strong thoughts on where I think the carbon necessarily that side of things. I am curious if you have any thoughts. I haven't spent a lot of time trying to piece that together, but I just think the regulatory environment does worry me a bit, especially in Canada.
I think the reality is the reason these stocks trade at the valuations is there's been a latent price of carbon put into the stocks already. And one thing that's interesting, if you just think of a global price of carbon, call it $80 a ton. Whenever Hertz did their deal with Tesla, 100,000 vehicles, stock went up about a high increase in value of Hertz. And whenever I backed into the number of vehicles and the carbon offset, it ended up being about $90 to $100 a ton of carbon price that the meme stock crowd actually on an equivalent value priced into Hertz of carbon offsets and reduction. And I don't think anybody actually thought about it other than maybe me trying to do that calculation, but it uniquely came into about the same price of, where carbon pricing is in the power sector. And so just kind of taking a step through, like, in the energy transition 101, power is 37%, industrial 30%, transport's 20, and then residential commercial 13%. So like when you think about the world, and then 66% of all, energy is non-OECD. And so, there's this like huge option of like $80 to $90 a ton subsidies actually kind of start getting into a reasonable value of what the price of carbon is in the stocks. And why I say that is the reason you trade at a 3 or sometimes sub 3 times multiple for these companies is the market has priced either a terminal value or price of carbon into the future cash flows. What's interesting is you think about the other subsidies, like the EV subsidies are kind of $450 a ton. the renewable diesel in California is about a $200 a ton subsidy, and so like the carbon capture market, which is about a $2 trillion a year TAM, it's really only an $80 a ton type market, and so like there are subsidies out there that are multiples of that value, and I've gotten into carbon over the last year. My 2020 hobby was cryptocurrencies and blockchains. My 2021 was carbon and carbon trading. And I think that's going to continue in 2022 because I really do think that carbon capture is probably one of the things that is the most logical enabler of, again, figuring out how the world releases this pent-up solar fossil energy and at the same time offsets that by putting carbon into the ground a lot of different ways.
It'd be tough to do carbon capture if they keep blocking all the pipelines.
Well, you got to end up figuring out like where you can do it. And so like luckily Texas, Louisiana, Oklahoma,
right,
North Dakota, Wyoming are kind of willing to do it in state, but no, it's going to be hard. And then you think about CO2 is, you pull up a material safety data sheet. I was putting on my old engineering hat. It kills people. It's heavier than air. And like, the fact of like, if you have 2 barriers for natural gas high pressure wells, you probably have to have 3 for a carbon injection site because there is a whole lot of risk to. You just think about it's the bubbly stuff in your vodka soda, but you concentrate it to 100% with no water in it. It's pretty nasty. And actually relatively dangerous.
What's interesting?
So you got to figure out how to do it.
I was going to say, what's interesting on the carbon side is that we looked into oil field applications around, what can be done. And there's a ton of CO2 at these amine treaters. I mean, there's all these different areas along the value chain.
Yep.
And I think that where the credits, at least the 45Q, is that what the ones are called now for CCSU? Is it 45? I can't remember the number on it.
Yeah, 45Q.
Yeah, so the 45Q, and you look at that, and it's almost like it's specifically designed to exclude anything oil field related, right? It's like you have to meet these certain criteria of a certain amount of emissions, like 350,000, which would be a huge facility in oil and gas. And you also have to, there's like non-aggregation rules. So it's like you could lay pipelines to the Permian right now and, pick up a bunch of CO2 and start injecting it, but you're not going to get, outside of maybe this offsets market, which you're talking about, it just seems today it's just at this point where you almost look at it and say, this isn't going to be something in the oil field that we can do unless it's at this larger scale. You have to almost be at these massive facilities, maybe LNG terminals, maybe you lay something up the gut through the Gulf. I don't know, but.
No, it's wild. Jared and Rystad Energy, I'm a big fan of them. And their data set had a data point of, to get to net zero. So like right now, their numbers are you pull about 4.2 gigatons of carbon out of the ground with oil every year, essentially. And like the carbon capture targets by 2050, you need to be putting 1.5 times that into the ground per year. And so like the reality of, think about that in the next 30 years, you need to build a carbon capture global industry that is 1.5 times the size of the global oil industry to meet some of the net zero push. But the reality is you don't have to get close to that. You just have to start getting in and around it. So I have a high view that the carbon pricing and value of carbon is going to go up because I think we're going to keep consuming oil and natural gas and NGLs. And so like the push will start becoming this kind of move towards building out this $2 trillion a year carbon capture market.
I actually really like that as a way to play more resilient demand. Instead of trying to bet on oil and gas prices, bet on I think you might have something really interesting there, betting on the carbon prices for all the reasons you just laid out. And I don't follow the market closely, but I do know that it was a huge winner I stay in touch. So the old firm I used to work with is pure trend following. They don't do any fundamental analysis. And the CIO just blasted me this chart of carbon offsets just going crazy. And he's like, do you have any idea what's going on here? We have no idea, but we're making a ton of money on it. And I was like, it's one of those things that when you have a politically determined market or it's heavily politically influenced, that's when you can get some of the best trends and the most market dislocations. And it's, I'm wishing I knew more about it, but I think it's definitely something I'm going to have to start paying more attention to.
Well, I think this could segue. I was going to say, I think this
Max was actually hitting it pretty. Yeah, we can probably get into some questions. We've kind of been going for 40 minutes, and we've got a bunch of people. If anybody had questions from the audience, just Max can handle that. But
I was going to open it up at the end. Where I was going with the carbon capture stuff is what's interesting to me is that through this energy transition movement, there's so much industrialization that has to happen to do these things, right? To build solar panels, batteries, all this stuff. There's a massive amount of industrial activity that, really what they want to do in terms of ramping it up, it's never really been done. I mean, the mining, everything. And what you're seeing is that all those activities, for the most part, are trending towards places where they don't have the environmental restrictions that they have in the West, right? So it's like we want to transition, but we have to offshore all these things because we can't do them here. And I think that will be the problem in my thesis that I'm thinking of right now as we're talking. I've not really thought this through that much, but I think that could be a problem with the carbon capture side in the U.S. and in other places in the Western world, is that this not in my backyard syndrome. It's a ton of industrial process. We're going to have to build huge amounts of facilities and pipelines everywhere. I mean, one of the only major pipeline projects that gets announced for carbon capture, and Sierra Club and everybody else is coming out saying that they're not going to support it. They're going to block it. All these activists are going to block it. So, we have the ability to reduce emissions dramatically here in the U.S. I've been preaching this. It's been one of my things. Not that I'm not saying I'm for or against these things. I think carbon capture is a tax on poor people, quite frankly, because it's going to make the cost of energy go up. So I have a weird moral confliction with it. But I think that to even do it in the U.S., you have to be able to build a ton of pipelines and do a ton of industrialization, which seems to be very, very against where most of these movements want to go. They're pretty happy having everything be dirty and have it be in China to where we can't see it. And so, Ross, you had mentioned before we had this discussion that you wanted to maybe dive into kind of this full life cycle of some of these technologies like batteries, renewables, in terms of the full life cycle of the environmental and carbon impact. And I think that plays well into Hike's comments earlier around Hertz and this premium that they were getting, or whatever it was, the way you calculated it in terms of the amount of carbon. So it's a very interesting thing to me.
So if you just real quick, just a couple things that the audience might find interesting. And first things first, so like carbon capture, and underground storage. So the question isn't, I think Aker had a great carbon day, so I'll plug them and the stuff they did in October. So this is some of their information, but the kind of numbers at what price, and you think about the regulatory burden and the regulatory issues. So $150 a ton in Europe, about $80 to $100 a ton in the U.S., and $40 to $50 a ton in the rest of the world. And some of that is just the cost of permitting, the cost of pipelines, the cost of actually building this infrastructure is just harder. The issue is most of the projects that are, there's around $400 million a year of CCS capital now that in the next 6 years will be $4 to $5 billion a year. And then in the 2030s to hit this 7.8 gigatons per year, which I just laugh at. I have a hard time not laughing at it, but it's another order of magnitude. So it's exponential numbers are hard for people to understand, and the carbon capture is doing it in the next 2 to 6 years, depending upon how fast things go globally. From call it $400 or $500 million to call it $5 billion, and then you could start getting into another order of magnitude, $50 billion type numbers if you want to hit that net zero number, which I just don't think happens. And so what I just want people to know that our thought process is that this is an enabling way for energy to keep moving forward versus the alternatives, and the subsidy is already in, the carbon tax on the poor is already happening, the access to capital, and that tax is already in the markets, and that's why valuations are where they are, and that's why capital isn't flowing into oil and gas projects. And so the reality of that is that tax is being put on people every day that oil and natural gas prices are higher because of the underinvestment that's been done really since the last 4 years, I'd say now. So I think that what I'm trying to argue for is that you'd actually enable a lack of more inflation of oil and gas prices by making these investments as opposed to the alternative. So I just wanted to share that, the numbers of why Europe is so much higher is regulation, why U.S. is higher is regulation and access to pipes. And as Max said, the rest of the world though can do it cheaper. And there's some better sinks and you can build it closer. the only other thing that I would hit is everybody focuses on oil and like the hydrocarbon side, and that's why I hit those percentages. 20% of emissions are on the transport side, which is primarily oil. Cement globally, two gigatons a year of carbon emissions. So 7.8 gigatons need to be put in the ground in 2050. Cement on its own, that industry, is 2 gigatons per year, and that's just a chemical process. And so even if you say, I don't want to benefit oil supplies by carbon capture, well, do you want to build anything? Do you want steel and cement? Like that alone, you should be building carbon capture and figuring out ways to do offsets, for cement to be made. So this just feels inevitable to me on the carbon side, and is probably one of the things that is everybody on this call that's in the oil business ought to be excited about, because your geoengineering skills and geotechnical skills are going to be able to be put to work in and around big projects that are going to consume a lot of capital and make good returns, because you actually have a low cost of capital for most of these big infrastructure projects, given the flooding of capital into the market. It's now just getting them off the ground and going. And I do think that's going to be something that 2022 through 2025 is a trend that everybody should spend some time on.
Yeah, absolutely. I'm definitely going to spend a lot more time on the carbon market after this call. So I appreciate you bringing it to my attention. I think there's going to be some really great opportunities in that space.
So on the other side, though, Max, I think you did hit something that, the question is as you think about trends or themes, I'm curious for this group, like where would you draw the line? Would you take the over or under on $80 oil in 2022? Max and Ross, I know you guys don't predict this stuff for a living, so just feel like putting you on the spot on a few things.
Well, I'll just real quick because Ross is giving some of his price stuff, and this gets back to the OPEC thing. I think that the game theory has changed with OPEC. Before, when we had this market share battle, I think that the game theory was just different. Now you've got what is every bit a finite resource. Don't kid yourself. Everybody's reserves are a finite resource. In the game theory, if you can produce those reserves, which you only have so much of, at a higher price per barrel, then you would be incentivized to do so. The other thing is that inflation is real, and it's flowing through virtually every level here. And I rarely hear it talked about, and maybe there's a good source and someone can point me to it, about supply chain and cost inflation as it pertains to OPEC in those countries. And I can't imagine that they're having an easier time than we have here in the West or in the U.S. in terms of getting the things that we need to do to industrialize. I think everybody's having a problem, and I'm sure in the Middle East and some of these countries, it's probably just as big or bigger of a problem there. And so the idea that they can just pump more barrels and we'll go back down to these lower price levels, I mean, why would they do it? Number one. Number two, can they even do it because of the supply chain things? And then number three, they'd be making even less money because of inflation. So I just don't see like the OPEC narrative of them pushing the prices back down. Doesn't hold a lot of water for me. But I mean, so I think it could easily get to 80, and I think it'll very easily could average over 80 for next year.
Yeah, I would echo that. I think $100 is actually in the cards. The biggest unknown to me, and this is why I always struggle with making calls on oil, is that I think the first half of, and this is just a macro call, but the first half of 2022, things are looking good. The economy is continuing to sort of hum along, and you've got corporate profits at record levels. But I do think the inflation is going to start to bite. I mean, historically, inflation has killed every economic expansion, especially, I mean, we're at levels of, 40-year highs. That's eventually going to start, and I think it is starting to eat into the lower end of the consumer. And I follow a stock that's a discount consumer space that I'm actually doing like a deep dive on now. The low-end consumer is really struggling right now, and the high and middle-income consumers are doing okay because of asset prices. But if the Fed is going to tighten monetary policy, and I don't think the first, winding on the balance sheet expansion is not that big of a deal, but as you start raising rates, I think we're going to have a lot of trouble with this sort of asset bubble that I believe we're living in, and then just the broader economic expansion, I think, is going to get tired as you pull away the fiscal stimulus and you start to raise rates. So if you can tell me that we're going to keep doing whatever it is, $90 billion a month in QE, and the Fed's going to keep rates at zero, I see oil going to 100, no problem. But if inflation stays up around these levels and the Fed is forced to hike, and then you've got the fiscal cliff kind of looming, I think we could easily get back into some lower oil prices. But that's just based on the economy shutting down and asset prices kind of deflating. So that's the struggle I have is I'm bullish on the oil fundamentals, but sort of bearish on the broader economy going into like the second half of next year.
Yeah, that's a huge question. I mean, the economy piece and what they're going to do has been really at the center of a lot of the different podcasts and whatever, all the different energy themes. And you've been very, Ross, I was joking the other day, I think I tweeted, I said I like bull Ross instead of bear Ross, but the bear Ross is thought-provoking as well. And I think that you're very anti a lot of these trends, whether that be in the the meme stock stuff or the Tesla or electric cars or cryptocurrency, whatever it is, like a lot of the stuff that's you believe benefits from this loose monetary policy. I think you've been pretty bearish on it. As I look more into these topics, and maybe this is just my Bitcoin bias from all the echo chamber that I'm around, but it just seems like they don't have many options, right? They can tighten and they can raise rates, which is going to, in the short term, be very bad for things like you just said. But long term, I mean, they don't have the times they've tried to do it. It's been very short lived. It's like a speed bump, and then they have to just start pumping again.
I agree 100%. They're gonna try to modestly tighten like they did in Q4 2018. It was 100 basis points, and they crashed the stock market, and that was from much lower levels, and that was before we had $1 trillion in margin debt and all the meme stock craziness. So, yeah, I think they're going to try to tighten. They're going to cause a big hiccup, and then it's going to be back to zero rates. And I actually think we're going to be at zero for pretty much indefinitely, minus these little modest tightening efforts. And that's why I think if you have a long view, say 3 to 5 years, energy is going to benefit from that because, that loose monetary policy and being stuck at zero, why would you not want to own double-digit cash flow yields in an environment with zero interest rates? It's one of the few. Energy is going to become, I think, one of the few places that you can go to get an actual income and an actual safe, not buying a junk bond that's going to yield 4% and then lose 30% of its value in the next recession. So yeah, I'm super bullish. I think we're staying at zero rates indefinitely, and then I think energy is going to be one of the biggest beneficiaries because these companies they have really attractive free cash flow yields. And over time, I think prices are just going to trend higher minus cyclical ups and downs.
This probably isn't the right group to have this conversation, but I'll plant another brain thought for everybody I think bonds as an asset class might be permanently broken. And so as you think about, the 40% of your portfolio as you turn 60, you ought to be in bonds and all that stuff. It doesn't actually provide real income, and it's dramatically exposed to interest rates. And so if you have zero interest rates or negative rates, then how do bonds actually work? Essentially, you have zero coupon bonds with no premium, where you don't have a guarantee of getting your value back on the other side, Ross. It's something that you just triggered the thought of. And normally in a zero coupon, you're guaranteed to get your $1,000 back. But we don't have that. And so as an asset,
term, it's return-free risk. Someone coined a long time ago, and I think it's absolutely true.
So if you're looking for income, I do think that is a flawed asset class as a whole. And there's probably people on here who know a lot more about bond trading and that thought process to me. But if you just think about the purpose of a bond, I don't know if it works at zero and negative interest rates.
Well, the mechanism for risk is broken just in general. I mean, you don't have a way to price risk, really. I mean, it should be the bond market, right? I mean, and that's broken. So by you saying that's broken, what you're really kind of saying is that the mechanism to price all risk is broken, and therefore this risk-free rate and all these things that you in finance that you're calculating everything off of these discount rates. It's like, how do we really know what those are? Because I
think that's exactly right. And I think when you view it in that frame, it makes sense why we're having this speculative mania in the market. And I think that comes back why that matters for energy is if you're an investor, you have to put capital to work and you want to earn a return without taking extreme risk. And I think that's what most of the stock market offers these days is, yeah, you can have a year like 2021 where I think we're up 30% on the S&P, but what's the drawdown risk you're incurring? Whereas you look at some of these energy stocks and it's like, yeah, sure, they're volatile day to day, but you're buying something that's really producing some good cash flow, even at lower oil prices, and you're getting that. If we're all wrong and the economy's fine, then you're going to have that uplift that's probably more upside than what's in a $1 trillion valuation in a company like Tesla or whatever. So you have the upside to positive economic growth, but you're also, I think, more protected on the downside because, as we've been saying, there's probably a higher floor on oil and gas prices because of the capital impairment. And so I think 2020 was such a worst case scenario where you had oil negative. I think that scenario is officially like off the table. But a big fear in the market is how low can oil go in the next recession. I think we could go into an environment like maybe the 1970s or even the dot-com bear market, where even in a recession / broader bear market in stocks, you could have resilient energy prices because of the supply-demand stuff we're talking about. And that's why I think the energy sector is ultimately going to become a safe haven for people looking to make a decent return, that you've probably got some pretty good margin of safety on the downside in a whole range of scenarios, because the idea that oil is going to go negative again, I think, is just completely off the table for the foreseeable future.
Yeah, no doubt. I mean, outside of some lockdown, I mean, that's another huge how shut a world economy down virtually overnight. Is that always going to be this kind of looming risk? I mean, is it like we never thought that this was a possibility? But just from now future, I mean, you're still seeing like pretty radical lockdown.
When things happen, you have a food shortage, you have a banking sector run, or you have blackouts. And so we lived blackouts in Texas last year, and it's an outcome of people just being frustrated. And I don't see and maybe it's just me in Texas, but we were talking about trying to do some marketing. No chance I'm going to London. Like that's impossible. New York and Boston, even with a vaccine, I can't get into any buildings. Can't do the West Coast either. And so I can go to the Midland, Dallas, Fort Worth, or Houston. And so the reality is where you've got an opportunity. I think we're probably, it does appear happening as well. But I think you're probably the closest to the heat on that. But I'm curious, Ross. I don't see Texas ever shutting down. I mean, it's full and not that the symptoms aren't that bad, and that's just lucky. I think the problem is that we're. I find it interesting. In a 100-year window, 1918, 1919. It sure seems like we could have more of these viruses than fewer, as we've had now 3 of them since 2020. And so, I do think there is this risk of we're living in a world where luckily biotech is making a political statement, but that's a blessing because it does seem it's actually helping people. Would have priced in the last 10 years. And maybe it's fighting the last war, but you've had that increase in activity. And, as we become more urban, there is this scaling of cities allows good things to happen. Don't have me read. But scaling laws also kind of exacerbate the negatives as well of crime and poverty and disease. So of get both sides. I actually think as we've urbanized, that I think it's just super interesting when you think about the entire time that I've been investing, we call it 2000 forward. China's been in a world where you call it 20 million people per year were moving, growing. Like the reality now, if you look at Chinese workforce, it's actually flatlining and projected decline. And so that actually pushes China now monetary currency as well. And so they didn't stimulate the economy, which would have been their traditional move. Dramatically because they don't actually have as many the worker growth is actually. Thing that I don't think a lot of people think about from a demand standpoint, and from a monetary policy standpoint, that is something, you know, in the theme for the next 7 years that I've now planted 3 different into. China is changing.
I was going to say about your point around the more viruses. I think, not to get too conspiratorial, but what we saw this fall was that it can be a very potent, even just the threat or the perception that there could be a new virus or strain seemed to be an incredibly effective political tool, if that was what it was, which I don't know that it was. I think that I hope that these people are being, they're being truthful and doing these things and putting out. That was very beneficial. Biden, was it coincidence that for a month all he talked about was how he was going to lower the price of oil, and then Omicron, which has been very, very mild by and has in terms of energy prices, or then even to go another kind of conspiratorial level, look at all the problems that China was having with Hong Kong and all these things right before all these lockdowns. And I'm not saying China virus on purpose. So you can prioritizes taking people's rights and suppressing people, and now this is a tool that is probably the most effective one they've ever seen. But go ahead.
But I like the conspiracy theory. And
I'm saying that they released it to do that. I'm saying that wasn't
never let a good crisis go to waste.
Yeah, that's why my point is that like the crisis is an effective tool now for certain things, right? So in the future, just the threat of it you could use that. You don't have to actually create a virus. You could just be like, hey, this could be happening, and it could cause things geopolitically.
So phase 1, I mean, again, I guess it gets into like, what are you trying to accomplish? And so phase 1, COVID was bad. It is what we should do. And in 1918, there's some influenza cases versus Philadelphia that had a Veterans Day parade and had the worst set of cases. And so, like, just from a global health standpoint, you're making me get there's a ton of data analysis around COVID in 2020, Israeli data in the older population slowed down the death rates. So that was a good thing. Like the death rates slowed. You're granted about it, and if you don't, that maybe you had a bad grandpa. I don't know, but it was like Delta was worse. But most people were vaccinated, or you had natural antibodies if you'd been sick. And so, like, the thing that is odd is the politics of not antibodies. You got a vaccine, you have antibodies. Like, that should be the same outcome, and so you should measure the total number of people that have antibodies, and Delta, was worse and had worse symptoms. So that led to more fear about your grandparents. Now, Omicron actually is kind of widely leading to high level antibodies, and probably another state with more vaccines, more boosters and delivered. And like they then want to populate as much as possible, and this variant is accomplishing that very, very quickly. And so I hope that's what's happening, and we can get past this pretty quickly. Now the government policy question is like I don't know if shutdowns actually help Democrats win elections anymore. And so I think that they're actually looking at ways to spend more money as a way to potentially save elections. And like I see this like not economics going into 2022 in America. And so like the more shutdowns actually seems like it's a negative bias around the economy. And I think that, and I do think that it is a fiction. Why would you control populations through shutdown whenever it actually hurts the economy and likely lowers your chance of being reelected in places that are like the U.S. that are republics? So I think the swing's going to be back towards some sort of Tea Party type system again, where U.S. spending will start coming down. As we have a swing in the House, and probably the that will be really interesting. But bullish, and if you think about it that way, so
Ross,
I keep coming.
I was going to say, Ross, thoughts on that, and then I've got time here this morning. I don't know about you and David, but thoughts on rants. People want to come up and help you in the DMs. I can do too. But go ahead, Ross.
Yeah, no, we can go ahead and open it up. I don't think I have anything really to offer on the political side of things. Just to say that I do think the lockdowns are, I think, we're moving past that. I don't think it's in anyone's interest anymore, and see what the people want to talk about.
I'll wait on that. So first, Josh had sent me a few. Let me pull them up. He asked about how to mitigate the risk of carbon markets due to them being artificial / created by government policy versus an actual commodities market. And this is one that I really, really struggled with. And I think that whenever I started looking at carbon capture, fundamentally what I didn't really think through it just initially when we started digging into it, and this is the and all these other things. I said, it's with Pickering, and he said, no, the ship's already sailed. Like it's only going to get better for these things. But I don't know. I think that that's definitely a risk. And a hike, we've talked about it before, but Ross, your thoughts around the arbitrariness of that space.
I don't know. I kind of take a different view. I mean, there's always risks when you're trading commodities, especially in leverage. And I think the way I learned coming up from a macro shop is you just control your risk through position sizing, using stops. But I think historically, the markets that have had the most powerful moves are the ones that are most impacted by policies and the artificial constraints of policymakers. And I think the carbon market is a perfect example. And that's why I'm excited to learn more about it, because there's nothing, there's no more powerful force to create a price dislocation than arbitrary political sort of rules and regulations. So I think that could be a great way to create some really powerful trends to make some money on, because there's usually a good bit of irrationality imposed by the politicians when it comes to markets.
Well, in carbon markets, I mean, capture is making money on them because project costs have gone up. And so the maturity of the technology is there. It's now just a question of kind of going through the process of how likely it is to develop. And I do think that there's hundreds of billions of dollars of carbon trade since kind of 2008, 2000 markets really the problem was is they were ineffective. And so the policy, non-economic growth, once those prices were put in, and so the effectiveness of the price was not the actual implementation of what's being done is actually beneficial around these carbon capture moves. So
yeah, so I was gonna say, just to end that one, we've got a speaker up here now. Max came up. So the last thing I'll say on that one is that the pieces that I don't like about it is, again, down to this is a much broader and more philosophical discussion around the cost create a lot of distortions, and you can make money trading those distortions. But ultimately, I don't know how sustainable they are, because I don't think that they bring a good or a service to people right now. Is it wrong on that?
From an automotive side, and really putting catalytic converters around happening the life of the fossil fuel industry, and tying carbon capture to that or not. But I do think there is, that is a fair question of, like, do people get a job?
Yep.
Because you've got acid rain. Yeah, I don't see that yet. So it's true.
Mags, thanks for coming up. What do you got?
Well, so I started working in low carbon economic transition in 2009. I helped put in cap and trade when it comes to carbon pricing. And you're right, NOx and SOx, that was an effective program. It has not been implemented correctly from what I've seen, because of, like, you need to go higher. And it's been ineffective because politicians are afraid to do that because of the implications to, whether it's inflation, et cetera. And what governments tend to do is they pick winners and losers for technology. One thing that I'll say is, since I've transitioned from economic transition, one of the most fascinating things that I've seen about Bitcoin is that you have the market incentive that actually helps promote renewable in heat, like offering heat. For example, Bitcoin miners are selling heat offtake to so I've got economic incentive and versus political policies where you're like, hey, select this technology or here's the outcome. And you're hoping that where it's implemented across various sectors of the economy. And it's an economic source from back when I worked on it, and probably still is. And so you need other transitional technologies, which looked at in 2009 as a transitional tech economy in is seeing tech that actually has that incentive. That's what I wanted to throw out.
Well, you can take out the words, I don't know if you're done, I think you muted, but you can take out the word Bitcoin. You can insert the words free market solutions is what you're really, I mean, and Bitcoin does create some of those, right? But like that gets back to this whole thing. Like, is there a free market or a capitalist, play here? It's at the offsets level, and then at the credits level, it's top down and it's pick the winners, and that's what gives me pause. But David and Heike, anything you're to it?
I mean, process hit it whenever, and I appreciate the comment of retooled essentially for moving carbon, and in the public market there's the CRC is a lot about California, both that Zambia that could potentially be retooled, which is an interesting thing if you don't have to build more. And I think that's where you get into the Texas market or the Louisiana market, where you have infrastructure and you have good things. Like the transportation part is the hardest part. And then the question is emitters, other than large emitters that are trying to solve their own problems. Not that the chart industries, the air liquids or the Methanexes of the world, or and then you have the things, and so like connecting both pieces is the problem. What's going to happen though is markets, and that source of financing is important.
Sorry, I got booted off the stream. I don't know. Let me try to mute. Is it still echoing?
No, I think we're good.
I think we're good. Sorry, David. I don't know. Maybe he booted off the. No, you're still on. You're just. I moved the booster. It's messed up, but keep going. We got the spaces going. Everybody can hear it through the phone. So.
Yeah, exactly. So really, that's the key of like those gaps of where policy creates opportunity is what we're thinking for. And you hit it, Max, earlier of like how do you get a CO2 pipeline built? Well, we're thinking about it from the angle of who owns pipelines and who can retool pipelines as a way to benefit for that, and then pick up both the transportation component, but then the storage side doesn't seem that hard. So there's kind of a handful of companies that I mentioned CRC, Denbury, Talos, clearly Exxon, Oxy are going directly down the carbon markets path. Aker has talked a lot about it. And we think Enlink is a company that has some opportunities in Louisiana. So like just not making recommendations, you can learn more. I'd probably start with CRC's Carbon Day and then do the Aker Carbon Day as well, and and then you can kind of start digging in. There's a whole lot of interesting there, and the technology than starting to understand the economics. And it is each market for some reason. And the majority of them are driven by government policy.
Right.
But that's not going to be ways to maybe the services side.
These carbon capture pipelines, and you think about large scale infrastructure like natural gas or oil pipelines or tankers, you've got kind of supply pull or push and demand pull that these major lines, like if you're a Transco line, you get, the pipeline route it's there for a reason. It's strategic. Or if you're a pipeline going up to Chicago, like Chicago's not going away, right? But these major emission sources, like if you're a natural gas, fired plant or plant, those can be either or so you really need decades of stability, build long that pipeline has integrity, that you probably have, as long as it can pick up supply, that'll have some use case. And I think that when we're again projects to a cement, offshore making cement here, and then the next thing you know, they're making it in Mexico. So there's a lot of interesting nuanced challenges to that space that when you start to peel back in it, seems very difficult for me.
No, I think it's on that wants a 30-year carbon offset. Well, you want to know that I've got 6 carbon emitters that are feeding into one pipeline that can go into 3 different carbon storage sites. And so there isn't this point-to-point market. I think that's where the flaw is in trying to get the tax equity monetization, is you need to have like many, many emitters where you know that the carbon is always going to flow in and go into the ground regardless of the source. And I think that is exactly right. You need to build bigger systems, which that's billions and billions of dollars, and that amount of capital just hasn't been raised around it. But I actually hear the family moving around outside the door.
Yeah,
been on for an hour and a half. But I'm gonna everybody have a happy New Year. Thanks for the help out on the carbon markets. We're thinking kind of about it a lot at PEP Insights. So
yeah, absolutely. We should definitely connect. Thanks for joining, and I will definitely.
All right, bye everybody. Have a happy New Year.
Yeah, I'm fairly flexible today. I could probably hop on for another few minutes here. I probably. Play here.
Okay, yeah.
I guess my problem with this whole discussion is with a lot of discussions. What's actionable? I mean, it's all great to pontificate about this misguided government program, that misguided government program, but it makes for great sports radio talk. But how are we supposed to make money out of this?
In the carbon capture space specifically?
Anything.
Yeah, that's a great question. That's the question I think about all the time, is how do we make money? Go ahead, Ross.
Yeah, I mean, I think where I come back, that's why I don't spend a ton of time. It's probably not, a great way to make money for the average investor. But yeah, I think as we've talked about, and probably in the beginning, I don't know if you were around then, but I just think the energy sector in general, public companies, there's a lot of opportunities. You've got double-digit cash flow yields at, $60 oil. We're comfortably above that now. And then I think if you believe in the upside case, these stocks are sort of dirt cheap. So you could look at MPs. You could look at you could look at the average investor. You don't have to get too crazy trading oil futures or anything like that. There's some solid blue chip companies that I think are going to offer, 10 to 15, 20% returns on a conservative.
I mean, you mentioned earlier, Ross, around the petrochemical space. I mean, it's just only accelerating the thirst for petrochemicals around the world to have the modern we have is only bullish and seasonal trend. Seasonal trends. The floor is going to continue to march higher, I hope, with Henry Hub as we try to seek parity with the world. Could that be stymied through restriction of LNG? And then it just makes so much sense to continue to use it for power. I think along the way from peak oil, and Hayek has argued with me about it before. They've modeled things out, but I just think that the world wants cheap and abundant energy, and they want to have the lifestyles that we have in the West, and to think that all these billions and billions of people that don't have what we have aren't going to want that, and that they're just going to like drive electric cars or something. Like, that's not, I don't think that's real. So I think there's going to continue to be ways to make money in the energy space.
Yeah. So just as an example, enterprise product is one that I've written about. My point. I just find it incredible. That it's just one of the examples of in an environment where you have treasuries across the curve under 2%, you've got inflation at 7%. Every fixed income instrument is trading at a negative real yield with extreme risk, I think, in this environment. And then here you have this world-class company that it's not just the sort of the historical track record and the asset base, but just on a conservative outlook, let's not even say oil's going to 80 or 100. Let's just say we stay here forever. This company is offering a 9% cash dividend with growth opportunities in the NGL space, which I think, if you're to bet on enterprise as an example, you're not even betting on necessarily the world consuming more NGLs. You're simply betting on the U.S. taking market share globally through exports, which has been it's been a trend since 2010. We have the cheapest NGLs in the world. We're exporting them across the world, taking market share. So even in a declining energy environment, U.S. shale still is the cheapest global source of NGLs and nat gas. And I think that trend has at least a decade to run. So, I just look for the no-brainers. To me, Enterprise Product Partners is a no-brainer. I mean, if you're looking for a reasonably high yield, which 9% in this environment is pretty high, that's got a solid margin safety. I think great value right now. I think there's opportunities everywhere in the energy space, frankly. I mean, you could probably just buy a basket. If I had to make one easy bet for probably the next 5 years, I would be willing to wager. I think that's going to outperform the S&P by many, many percentage points. I don't want to make a specific bet, but I just think the value there is there. And it's in a world with every other asset class that I'm seeing, energy is like this rare spot that's just got really solid fundamentals, low valuations, high payouts in terms of dividends. You can go on getting a basket of high quality energy stocks is a very.
Yeah, anybody? We've been going here for a while. Appreciate everybody joining the room. This is a good one. All right. Well, looks down, Ross. I appreciate you doing this. This was good. We need to do something else in the future. I had been wanting to do some content for a while and I've been following your stuff. Let everybody know where they can find you.
Yeah. So I write a Substack, and the link is just right on my Twitter handle. So you can just find me on Twitter at Ross Report, or just Ross Hendricks. And then I'm also, I do some work for energy funders. They do direct energy investing for accredited investors. And you can find us on Twitter as well, or reach out to me. But yeah, I appreciate you having me. It's been great. And I do think we should definitely collaborate more. I think you guys know each other. And I think there's all kinds of opportunities to collaborate. So let's stay in touch.
Absolutely. So for everybody else, I'm going to release this to the podcast channel. It's the Talk.Energy podcast on YouTube. You've also got it on usually interview on Monday, And then on Thursday or Friday, we'll do a Spaces and/or live stream. So appreciate it, everybody, and hopefully you guys join us in the next one. Thanks, Ross.